Hey traders, Clifford back with another video on how to trade the index. So today I wanted to go over Fibonacci a little bit and how it is the best way to adjust your Fibonacci levels as time goes on. So with that being said, we're going to get started here now. Now, for those of you who are new to Fibonacci when it comes to trading, you can definitely check out one of my other videos. I definitely go into what it is, but basically it's a numerical sequence that kind of helps you gauge which levels the market can react from, and it also helps you find the best support and resistance levels in the market. So basically, if you got a chart here like the ES, this is the S&P 500. Normally you would just take your Fibonacci tool like this, Fibonacci retracement, and you kind of like, draw from the top to the bottom, right? You always want to find the most significant move, and that's how you do it, right? You just kind of like draw your levels out from the top, and usually the top is going to be 100% of the move, and the bottom's going to be zero, and then the middle is going to be 50% level, and the most important level, in my opinion, is the 50% level. Also, the 38%, the 23%, as well as the 78%. So, but what do these levels really like do, and what do they mean, right? Well, basically, they are a numerical sequence where the market is known to react at these levels. So basically, what you want to do is get the high of the move and the low of the move. In this case, I'm looking at the biggest move in the S&P from October of last year till the top up here of July 16th. And then you can actually like place orders. So like let's say you were going to buy the S&P, you know, maybe you want to wait till it rejects a level like this, 78% level, because if it rejects this level in the future, you know that it could be putting in a floor in the market, right? Another thing you could do is you don't have to take the biggest move, although I like to go as long term as I can. But let's say you just wanted to measure the most recent move, you could do it here too, right? You could do it here. That's a recent move. And now you're getting the low from April of this year to the high of August. Sorry, not of August. Sorry, of July 16th of this year. And look what's happening. So now we're at the 61.8% level, and boom, the market's bouncing off of it. Bouncing off of it. That right there could be a sign that it's trying to put in a floor. Now, it doesn't mean that it can't reverse lower. It could still go lower eventually, it could do whatever it wants. What I like to do is I don't use all these colors. I mean, you could use all these colors. Mine's a little different. What I like to do is just kind of like make it really simple. Um, I change the colors to black, and then I put these little gray lines. So that way my chart isn't full of so many colors. So now, here's the big question. I was measuring Fibonacci here back in October 2023 up until this high. This was the all-time high back in June. But now it's actually broken to a new high. So what do I do? Well, I have to readjust my Fibonacci levels in order to be in line with the market. So what I'll do very simply is if this was the all-time high, but now we have a new all-time high, I would wait till that high is established, meaning the market pulls back from that high. Then you have a pretty good idea that that was the actual high that the market is defending right now. And then what I would do is this. I would take my old Fibonacci here, which was back in June 17th. This was the all-time high in the market when the S&P was at 5200 5227. Then it rose up to 5721. So now I have a new all-time high. I'm going to go like this. I'll take my top of the Fibonacci, move it up here. Okay, I'll leave the bottom there because we didn't make a new low. That low is still holding since October 2023. And then what I need to do now is minimize it so I can adjust the new uh, this level here. So I take the tool, right, and I go like this. I take the top of the tool. This was my old 100% level, but now this is going to be my new 100% level, right? So I put that there, and then I go back, and then it's still not right because look, the old 50% level was here at 48.76, but see, I have a new 50% level here, so now I move this up. And the reason I like to so now I'm currently aligned in the correct Fibonacci levels. The reason I like to bold in white these levels is because I think they're the most significant. The 100%, the 0% where the move started, and the 50% level. The 50% of the retracement, uh, Fibonacci states that markets will always retrace 50% of the last big move. So with that theory, what that means is that like when you have a really big move, the market normally comes back 50% of it. Over time, I mean, it's not always 100% guaranteed, but a lot of times the market will retrace 50% of its last big move. And so now I'm aligned correctly with my Fibonacci levels, um, you know, and now I'm watching. So now I can see here 5,400, right? That's probably, if the market makes it to 5,400, pulls back down here, that's a place that we could get a bounce because this is the 61 or sorry, the 78% Fibonacci level. If that level didn't hold, then I'd be looking for support to hold at the 61.8% level. And that's basically it, I mean, and I do that for all the markets I follow. Like here's the Dow. I haven't adjusted this one yet, but I will because it made a new high. Here's the NASDAQ. I already adjusted this one. Um, Now here on the NASDAQ, see we had that level there. What level is that? 78%. And look, the market uh, smashed right through it. So the support didn't hold. So that means I wouldn't want to be a buyer. What I like to do is watch for levels that get rejected because then I know that the market's probably not going to come back there. And I usually watch the Dow, the S&P, the NASDAQ, and the Russell. Now the Russell, if I look at my levels here, here's the Fibonacci for the Russell. And yeah, see, I'm in line. Here's the low of the move. Here's the high of the move. My levels are intact right now. So what would I do with the Russell? I would, if I see this level's tested, the 78%, right? And I see a rejection from that level, meaning the market kind of touches it and boom, bounces back from it. That possibly would be a good opportunity for me to enter a long position on the Russell because you always want to see rejection before you take a risk. In my opinion, it's better that way because whenever you see rejection, that usually, like you see here, see here's what I'm talking about. See here is the 78% level. See here how the market touched that level, reversed off it, touched that level, reversed off it, touched that level, reversed off it hard. Those reversals is what you want to look for. That's going to make you a better trader over the long term because typically reversals mean that the market doesn't want to go lower. So that's that I think is one of the best ways you can kind of gauge what the market's doing. So that's about it for this video, guys. If you enjoyed the video, feel free to like, subscribe, put your comments below. Look forward to seeing everyone in the next one. And as always, my friends, trade what you see on the charts, trade well.